Let's go with another session of the Forex Day. We are going to start with Marshall Gittler. He's got 30 years experience. He's a very well-known expert in fundamental analysis. He started his career in the main investment banks and international brokerage firms. He's been in with all the big ones in US, Bank of America, Deutsche Bank, and now he is FX Primus. He's the chief of FX Primus. So today he will be talking about the latest advancements from Bloomberg, the upcoming votes, Brexit, the US elections, and their impact on the FX market, sponsored by FX Primus. So Marshall, you've got the floor.
And I just want to say how happy I am to be here in Madrid. It's only my second time here, and last time I was just here for 12 hours. So I'm really excited. I'm going to take some time off and see the country a little bit afterwards. You know, I wish I could do this in Spanish. I wanted to learn Spanish when I was younger. Many years ago, I actually spent a summer in Mexico studying Spanish and traveling, but that was a long time ago, and I'm afraid I forgot almost everything. All I can say in Spanish is una cerveza más.
One more beer, please.
Useful in my life, so I'm glad I learned how to say that. Well, today I'm going to talk about the two big elections that we have coming up. The Brexit, which is in a week or two, 2 weeks or so, and then the US election coming up. These are big political risks for the market. So I'm going to talk about what Brexit means for the market, and I'm going to talk about what the US election means for the market. I think these are the two big risk events, the two known unknowns that we face in foreign exchange this year. So first off, Brexit, the near-term risk, what it means for sterling, what it means for the euro, and what it means for all currencies, for the whole FX market. The main point that everybody is worried about is what this is going to do to Britain's trade. Britain it's very dependent on trade, and it will have a big effect if it pulls out of the EU. The EU is Britain's biggest trading partner, so what will the effect be? And it all depends on what kind of a trade agreement Britain can come to with the EU. Everyone says, well, Norway has a trade agreement with the EU and Switzerland has a trade agreement with the EU. It'll just be something like that. It'll be very easy. But these are very small countries. Britain is a very big country with regards to trade. So I'm not sure Britain can negotiate the same kind of trade agreement. Furthermore, Norway and Switzerland negotiated these agreements while they were outside of the EU. You don't have to raise your hands, but just think, how many of you people are divorced? Now, I'm still married to my first wife, but I think the relationship between me and my old girlfriends must be very different than the relationship between a formerly married person and their former spouse. I think if you never get married, it's one thing, but if you get married and then you leave, it's very different. And I think it's the same thing with the EU. The Norway and Switzerland have one relationship with the EU, but they never joined. If the Britain joins and then leaves, I'm not sure it can negotiate the same kind of agreement. And remember, all these agreements have to be unanimous. When Britain renegotiates trade agreement with the EU, it has to be unanimous. What is Spain going to say? Does Spain really want an example of a country leaving the EU? I think this would be a very dangerous precedent, and a lot of countries would resist this. So I think you would be in for a long period of difficult negotiations. You know, right now the EU is wrapping up trade negotiations with Canada, and they've reached a trade agreement. It's taken 7 years. 7 years for the EU and Canada to reach a trade agreement. It's going to take a long time for Britain and the EU to work something out, because no country in the EU is really angry at Canada, and still it takes 7 years. I think it's going to be really messy with Britain. And meanwhile, other countries might raise their trade tariffs against Britain, and Britain might retaliate with higher trade tariffs. It's going to be a mess. It's going to be a big mess if this happens with trade. Furthermore, one big thing, Scotland. The Scottish people are very much in favor of the EU. The English people are the ones who want to get out. So if Britain as a whole votes to leave, maybe Scotland has another referendum, and maybe Scotland votes to leave Britain. This would be a very, as you know, a very disruptive scenario for the Forex market. We saw this when the last time Scotland voted. So Brexit could mean not just Britain leaving the EU, but the breakup of Britain too. Now, one thing is that we all know, markets don't like uncertainty. Markets don't like unknown risks. If Britain votes to leave, there will be a big period of uncertainty, and markets don't like uncertainty. I think just everything that has a pound sign in front of it will be considered risky. And then you have to have a risk premium. The price has to fall to make it worth somebody taking that risk. I think there would be a very difficult time for anything, for British stocks, British bonds, British real estate, and of course the British currency too. German Finance Minister Schäuble said we would have years of the most difficult negotiations. He's talked about a poison to the economy of the UK and to Europe too, and the Scottish issue. So I think it would be really, really bad for Britain. Right now, British economic policy uncertainty is at a 20-year high. This graph, by the way, I may not talk about all the graphs because I just don't have that much time. We will have the presentation up on the website. Please download it and you can look at the graphs in detail yourself. But this is a graph of policy uncertainty. You determine an index by looking at newspaper articles, how many newspaper articles. British policy uncertainty is at least at a 20-year high, much higher than in the US or Europe as a whole, and it's only going to get worse. Markets don't like uncertainty. Furthermore, if Britain pulls out, because of this uncertainty, the Bank of England will keep interest rates low, lower for longer than they would otherwise to support the economy. Of course, low interest rates aren't good for a currency either. That would hurt the pound as well. But the big problem is Britain's current account deficit. The current account deficit in Britain has been widening and widening. It's now at a record wide level, 5% of GDP. And I'll show you the problem here. The problem is, first off, the trade, the yellow. Does this work? Whoops, wrong button. Sorry. Where do we go here? Right. Nope. I'm sorry. I don't know how to work this. I'll just walk over here. Right. Britain has a big trade deficit, these yellow bars, which is offset somewhat by a surplus on trade and services, the blue bars. Two things. One, the services, which are now in surplus, a lot of that is financial services. But Germany and France would love to take the euro business away from Britain. So if Britain leaves the EU, they'll probably make some rule that means all the euro business has to come back either to Germany or to France. So this trade in surplus, this surplus in services is going to fall. Oh, that button. Okay. Great. Thank you. Secondly, these red bars. You see, these red bars used to be on top. They used to be a surplus. But now they're down here. They're a deficit. What this is primary income. This is income from overseas investments. And Britain used to be making money on its overseas investments. Now foreigners are making more money on their British investments than British people make on their foreign investments. Because Britain invested in the wrong industries. British overseas investment is mostly mining, telecoms, and banking. And this isn't making so much money anymore. If, in any case, this is going to get worse. So if this gets worse, while the surplus in services falls, Britain's in big trouble. And how are they going to cover this? Well, right now they cover it by having a big surplus on the capital account. People are investing money in Britain. They're buying British bonds, which have high interest rates. They're buying British stocks, British real estate, and investing in Britain, direct investment. But, as I said, the Bank of England will be keeping interest rates low if they leave, so I don't think people would be buying as many British gilts. And foreign direct investment would be a lot less attractive. About 70% of the people surveyed said one of the main reasons, most attractive points about Britain to invest is that it's in the EU. If Britain isn't in the EU anymore, why invest there? If you want an English-speaking workforce in the EU, you invest in Ireland, not Britain. So I think foreign direct investment would fall too. In other words, I think the current accounts deficit would worsen, the portfolio incomes would fall, and I think the pound would fall as a result. So to sum up, the impact on the pound is negative. Negative, negative, negative. The uncertainty, just the uncertainty alone would hit the pound. The Bank of England would hold interest rates lower for longer. That would hurt the pound, lower interest rates. The current account deficit, which is widening already, would become worse. That would hurt the pound. The services surplus would fall. Gilts inflow would fall. Direct investment inflow would fall. So the portfolio inflows would fall. Nothing to cover the widening current account deficit. As a result, the pound would fall. It would get clobbered. Many years ago, just to show you how long I've been in the markets, in 1985, I wrote a story about how British foreign exchange traders were preparing for a parity party when £1 was worth $1, and they were going to have a big party. Well, it only got down to 103. 103 was the bottom. We could see it again. We could see that again. But the impact it wouldn't just hurt the pound, I think it would hurt the euro too. This is the thing that people aren't prepared for. The problem is the uncertainty of these negotiations would hit Europe too. And this uncertainty in the negotiations would probably mean slower growth in Europe. That would be bad for the pound, for the euro. The ECB would have to keep rates lower for longer. That would be bad for the pound. And also, the main thing, if Britain left, it would raise the possibility that other countries leave too. You know, a lot of people in France don't like the euro. A lot of people in Greece certainly don't like the euro. So there would be a lot of questions about whether the other countries would leave. A lot of other countries want to have polls, referendums like Britain. Maybe there would be more referendums. Even if they vote to stay in, just the uncertainty of the votes, I think, would hit the euro. So the uncertainty would hit the pound most, of course, but it would also hit the euro. Okay, it hits, so people are selling pounds, people are selling euros. What do they buy? Well, in times of uncertainty, people often buy dollars, especially if you're pulling a lot of money out. That's the only big market to go into. We saw this in the 2008 when we had the global financial crisis. Even though the global financial crisis was centered in America, the dollar gained because it's the biggest market, it's the most liquid market, it's the safest market. So I think the dollar would gain. Also, the yen and the Swiss franc just tend to gain when there's uncertainty for various reasons. So I think they would gain as well. Now, if all of this is going on, probably the Fed isn't going to raise interest rates. The Fed would keep interest rates stable. I think because of that, the emerging market currencies might benefit too. So we could see emerging market currencies rally as well. Net-net, Brexit, if they vote to leave, it would be bad for the pound. It would be terrible for the pound, bad for the euro, good for the dollar, good for the yen and Swiss franc, and probably good for emerging market currencies, just because the Fed would keep interest rates low for longer than it would otherwise. So that's Brexit. Now I'm going to talk about the US election, which is the oddest election I've ever seen. I mean, nobody alive has ever seen an election like this before. It's just incredible. Frankly speaking, I'm embarrassed to be an American and see this kind of thing going on. It's really, but anyway, for the market, the FX market, it's a binary outcome. As I said, markets don't like uncertainty. They like stability, they like continuity, they like to know what's coming. Hillary Clinton represents this stability. Some people like her, some people don't like her, but everybody knows her. She's been in politics for years. Everybody knows her, they know her positions, So if she wins, people can figure out, people know more or less what's coming. But Trump, Donald Trump, he's unbelievable. Some of the statements he said have been just incredible. For example, he wants $10 trillion in tax cuts. Well, great, my taxes might fall. But what would this do to the US budget deficit? I mean, it'd just blow up the US budget. He talks about restructuring the US government debt. Now, you know, everybody talks about Trump being such a good businessman. This is a guy who's gone bankrupt 4 times. That's why he's still in business. Because he goes bankrupt, he declares bankruptcy, he restructures his debt, and he gets his building back very cheaply. He thinks the US government can do the same thing. But what would the impact on the world be if the biggest bond market in the world suddenly declared bankruptcy and said, we're going to renegotiate all this treasury bonds that you have? Utter, total, complete, and entire chaos. I mean, we saw that a couple of years ago when they just talked about shutting down the US government and not raising the debt ceiling. No entiendo. ¿Qué es eso? No.
I don't know what that is.
What else did he
There's no water in my apartment. And
set up trade barriers? He probably set up the worst trade barrier since trade war since the Great Depression. And we all know how well the Great Depression did for everybody, but that's what he wants to do. And he's talking about withdrawing his armed forces, U.S. armed forces from South Korea and Japan, and renegotiating NATO. So the balance of power in the world would change. These are crazy ideas. I mean, they're not crazy, but they're radical ideas. Nobody knows how they would work. Uncertainty. The only world leader I can think of like this is Silvio Berlusconi. So when thinking, how is the dollar going to fare under Trump, I just look at Berlusconi, the Italian prime minister. And we said, this is Deutschmark lira during Berlusconi's first period. And you can see it went from 950 lira to the Deutschmark to 1,050 lira to the Deutschmark. The lira depreciated while he was prime minister. Okay, but the lira always depreciated, so I'm not sure that this is Berlusconi or whether it's just Italy. So we can look at what happened during his second term to Italian bonds. During this period, we had the euro, so we didn't really have, we can't just look at the performance of the euro. But from the start of the administration to the end, Spanish bond yields came down to be equal to German bond yields. The Spanish bond yields came down and down until they were equal to German bond yields. Italian yields, on the other hand, actually widened. They came down for a while, but then they started widening out again. And as soon as Berlusconi left office, they started narrowing. So clearly, the markets didn't like this guy, and the markets put a penalty on Italian assets because he was prime minister. And I think that would happen under Trump, too. And look what happened to the dollar when President Bush enacted trade tariffs on steel in 2002. After that, this is the dollar index, and the dollar index fell until shortly after they lifted the trade tariffs. And then trade wars aren't good for currencies. The market doesn't like to see trade wars. And when a country starts having a trade war, usually or often the currency falls. And I think that would happen too under Trump. But what happened to the dollar? What would happen to the dollar under President Clinton? Well, what happened to the dollar under the first President Clinton? It didn't do so well at the beginning when Lloyd Bentsen was the Treasury Secretary, but then President Clinton got rid of him and put in Robin Rubin, and the dollar did pretty well under the first President Clinton. And I think people would expect a similar thing under Hillary Clinton too. The fact is, and people might not recognize this, the Democratic Party is better for the US economy than the Republican Party is. In America, the Republican Party, Donald Trump's party, presents itself as the party of business. But actually, what's good for business isn't always good for the economy as a whole. Sometimes what's good for business is that people get rich, not that companies get rich. And if you look at the performance of the US economy, it's done better under Democratic presidents than under Republican presidents. Here we have the average and the median. And even, it's the same if we just look at presidents after World War II. Even if we take out the First Depression, we take out World War II, just the post-World War II presidents, same story. And if we look at the dollar has done better under Democratic presidents than under Republican presidents as well. This is the dollar index against the major currencies. It's done better under Democratic presidents. I mean, on average, it's fallen under Republican presidents, but the median, it's a small rise for both, but more for Democrats than for Republicans. Now, the fact is, though, the market isn't yet worried about Donald Trump. And that's because of the really strange way that the US elects the president. So I'm afraid I have to give you a little civics lesson here. When we vote for the president, we don't really vote for the president. We vote for a person who will then go to Washington and vote for the president. Because this arrangement was set up in 1770 something or other, 1780, and things were a little different there. They didn't trust people to vote for the president, so they set up this indirect system. You vote for an elector, and the electors then go to Washington and vote for the president. So you vote for an elector who is pledged to vote for your candidate. Now these electors are allocated by state. Each state gets a certain number of electors. And the key point is, whoever wins the state wins all the electors of that state. Because of this, you can win the US presidency with 29% of the popular vote. There are 17 states that have 59% of the electors. 17 states have 59% of the electors. If you get 51% of the votes in those 17 states, you win, even if you get no votes in any of the other states. So it's a very strange system. Of course, nobody's going to do that, but it means, what this means is that there are really only a few states that are important. In some states, they will never vote for a Democrat. In other states, they would never vote for a Republican. There are only a few states that might vote for one sometimes and one the other time. And the big states like this are the important ones. I'll show you. This is the states President Obama won are blue. The states Mitt Romney won are in red. Blue is the color of the Democrats. Red is the color of the Republicans. This is 2000, George Bush versus Al Gore. Whoops. 1 second. So let me go quickly back and forth. You can see not so many states different. And that's the difference between winning and losing. Actually, George Bush lost the popular vote. Gore got more votes, but he got more electoral votes, mostly because He won Ohio, and he won Florida. That's why people aren't worried about President Trump. Because to win, he will need to get at least as many states as George Bush got. But the composition of the U.S. has apparently changed since George Bush was running. There are 2% fewer white voters and more minority voters. And minorities don't like Bush, don't like Trump. I mean, he's especially Hispanic voters because he's very much anti-Mexico. And one of the things is Florida. See, one of these key states, Florida has a lot of Hispanic voters. He will have to win Florida to win the presidency, and probably he won't be able to. We hope. But you never know. You never know. Nobody thought he would become the candidate either. But in any event, people don't think he will win. They think Hillary will win. You know, women hate Trump. Hispanics hate Trump. Blacks hate Trump. College-educated people hate Trump. Well, anyway, I hate Trump, but sorry, so this is why most people looking at the situation think Hillary Clinton will win. Trump will not be able to do better than Romney did among white voters. He'll probably do worse among minority voters. We think he'll lose. But you never know. There's new analysis coming out about the U.S. electoral. It's possible that he does win. So this is why people aren't paying so much attention. They all think Hillary Clinton will win. She represents continuity. That things will go on. She'll just keep doing what Obama did. The Fed is independent anyway, and things will go along this way. But I think the market is underpricing Trump risk. Right now, if you look at the betting polls sites, they say there's a 35% chance of Trump winning. And I don't think there's a 35% risk premium in the dollar yet. So I think as we get closer to the election, the dollar could suffer because of the Trump factor, depending on how he seems to be doing. But if we look at history, I should point out the dollar tends to appreciate going towards an election. That's what been the performance up till now. I just took every election and tracked the value of the dollar against the other major currencies. And on average, it tends to go up towards the election and keep going up. I did it from May before the election to May after the election, with 100 as the time of the election. And it was very interesting. So I said, okay, what happens? Maybe it's different when a president who's been in there for 2 terms leaves office and a new president comes out. So I took all those instances and made a separate index of that and an index of the other times. And for the other times, there doesn't seem to be any trend at all. But in times like this, when a 2-term president is leaving and a new president is coming in, there's a very strong appreciation tendency for the dollar. Then it tends to fall afterwards. And why is this? I admit, I have no clue. I have no idea. I just present the facts. We could see the same thing this time. If people don't think Trump is going to win, if they think Clinton's going to win, maybe they think this will happen. But if Trump seems to be gaining, then I think we got problems. The dollar will have problems. After the election, I see the dollar continuing to gain. That's because both Trump and Clinton are talking about fiscal stimulus. And I think the country might be in the mood for more fiscal stimulus, especially infrastructure spending after the election. And when you have a loose fiscal policy and a tight monetary policy, the currency tends to strengthen. I think the Fed will continue to raise rates if everything goes well, so you'll have a tighter monetary policy, a looser fiscal policy. I see the dollar gaining afterwards. But then again, all my money is in dollars, so I want to see the dollar rise. This is my own personal bias, so please, everybody has their own bias. And the other thing I think that would happen after the election, I think the U.S. Treasury is going to put more focus on countries that are manipulating their currency. So until recently, they've left them alone, but they seem to be putting more focus. So there could be some pressure on emerging market currencies to let their currencies appreciate. I think a few countries, especially in Asia, may be under threat of having to see their currencies appreciate under the new administration. So that's my talk for today. I think Brexit is the big risk in the near term. It's a very close election, very close. Nobody knows what they're going to do. If they do decide to pull out, I think it will be the defining event of 2016, and I think the pound will get clobbered. If they don't, then the focus is going to move on to the election, and I think the market is underpricing the Trump risk. If there's a chance of him getting elected, then I think the dollar may weaken. Otherwise, the dollar tends to appreciate towards elections. Thank you very much. And now...